Be Wealthy and Smart, episode 1631.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about how do stocks react after military conflicts. Because as we all know, this last weekend, the United States participated in a joint attack with Israel, which struck Iran and killed the country's supreme leader, Ayatollah Ali Khamenei, which was an assault that triggered retaliatory attacks from Tehran. This led to sharply higher oil prices and the potential for the war to spread across the region, which could pressure the stock market for longer. Stocks were already close to record highs ahead of this, but the pace of the bull market had begun to slow on concerns about artificial intelligence's overall impact on the economy. According to CNBC, historically, geopolitical conflicts have little lasting effect on stocks. In data going back to 1980, the S&P 500 on average is unchanged the day after an event, according to Barclays trading desk. Studies show stocks tend to recover within a month after the start of a conflict. So is this providing us a good buying opportunity? Well, I would say yes. This feels to me like an echo of last year's quick decline on Liberation Day and fairly fast rebound and then on to new highs. That's what I expect to see given the current situation. Looking at economic news, the U.S. factory activity expanded at a slightly slower pace in February as the number of companies reporting higher prices soared, the Institute for Supply Management reported. The ISM Manufacturing Index posted a reading of 52.4 for the month, which was down just barely from the 52.6 in January and above the cutoff line for expansion of 50. So any number above 50 from the ISM reports that the economy is still expanding. The number represents the percentage of managers reporting growth in activity. An economist surveyed by Dow Jones had been looking for 52, so 52.4 was a positive surprise. All of that news helped the stock market to recover from the original drop in the Dow Jones Industrial Average of 543 points, or 1.1%, and the S&P 500 also opened 1.1% lower, with the Nasdaq declining 1.6%. The three major averages rallied as gains in technology stocks as Nvidia and Microsoft helped trim the losses. Gold futures jumped almost 2% as investors piled into the global safe haven asset. The president said that U.S. military operations in Iran are ahead of schedule, but investors are worried about a prolonged conflict despite those comments. He mentioned in his estimate it's going to take about 4 weeks. And we saw defense stocks and energy stocks rise after the attacks in the Middle East. The CBOE Volatility Index, which is an S&P 500 options-based measure that gauges how traders feel about market conditions over the next 30 days, surged 18% in early action. The move took the VIX over its long-run trend around 20, though the level was far from anything suggesting market panic. Crypto markets were mixed, and Bitcoin paired earlier losses to tick higher. It's still well below its October peak of around 126,000, currently trading around 65,000. And as usual in this kind of geopolitical turmoil, we're seeing gold rather than crypto rally, reflecting demand for stability and balance sheet protection, whereas crypto's weakness is more about liquidity tightening and positioning fatigue, according to Kurt Hemaker, CEO of Gold Token SA. He said there's clearly some tactical rotation into precious metals, especially in an environment defined by geopolitical stress and currency debasement concerns. The dollar also strengthened about 0.65%, while the Swiss franc also saw a slight rally. Benjamin Jones, global head of research at Invesco, said bond yields could rise in the short term on concern about higher inflation. While he said that some government bond markets could benefit from safe haven demand, inflation concerns would most likely dominate. On that basis, and given the energy independence of the U.S., we suspect U.S. Treasuries may be less impacted than European and Japanese government bonds. So looking forward, The concern is that higher oil prices can lead to stickier inflation. So what's really the important thing to keep an eye on here is how long this situation in the Middle East lasts, leading to higher oil prices. Currently, we're seeing oil about $70 a barrel. Should that be sustained for longer, that would filter through the economy and potentially cause inflation numbers to stay higher than what we would like to see in order for the Fed to be able to lower interest rates. On the other hand, the jobs market seems to be impacted by AI, and all eyes are on jobs being weaker in the future, with AI potentially keeping a lid on hiring more employees or even causing layoffs in the future. So we'll continue to monitor these and report back to you, since the economic information and keeping an eye on that is important for all of your investments. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.